All right, ni hao ma. G'day, mate. How are ya? Hello, hello, hello. Happy day. It's a Wednesday. Yeah. It's a Wednesday. It's a good day to be a currency trader. Well, we might be running out of volume and volatility, but there's still some opportunities out there. We're running out of news events, but there's still a couple around. So lots to be grateful for. Without further ado, let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. My name is Wayne McDonell. I will be your guide on this journey we call Forex, but I'll let you lead the journey, right? You're the lead. I'm only a guide. I say, don't step on that. That's dangerous. We should go around. But ultimately, you are the boss. You ask questions, and I do my best to help you learn the good, the bad, and the ugly that I've experienced over the last 20 years might be a useful pool of knowledge and a puddle of love. So again, ask questions, get involved, write things down, leave good comments, stay positive in your contribution to the community. Check your negativity at the door. Also invite you to visit Tradersway.com, a foreign exchange boutique trading firm that would love the opportunity to earn, think about this, earn your loyalty and respect. No, there's no weird banner ad that says you're going to get something super cheap or some ridiculousness, but instead they value your education by being part of our community. And why would a broker value your education? Because they hope that you become successful. They want you to succeed. Now think about that as their the base business model. They're hoping to have educated, conservative, disciplined traders with long-term views that don't over-leverage, over-risk, and are not likely to blow up their trading account. Instead, patient, disciplined traders that can trade successfully over long periods of time. Like, well, that business model actually makes sense. Yeah, I know, right? So if you like that, I think that's the best selling point right then and there. You're like, I get that. That makes sense. Good. Tradersway.com. Open a demo. Get on with it. Get on with it. Okay. Master says, hey, we should have an advisory board on the site. I like that idea. So we just log in and see notices. And well, I can leave notices, but it's not complicated. If you're a swing trader, we meet once a week. It's not that complicated. Can you go into the swing trading group and post trading ideas for others to comment on? Yeah. Can other people see it that are not swing traders? No. So it's not too complicated. Cool. But anyways, thank you for all your suggestions. You're on to something really good. So yeah, good morning. Yeah, good morning to you. So what do we have? We have yen weakness, great. Sideways, somewhat weak dollar. Sideways, somewhat weak Swiss franc. Okay. Fairly strong pound, fairly strong Kiwi, fairly strong Aussie, fairly strong Euro, but CAD is off. So generally speaking, we have some risk on. That's really good. I think you'll notice that some of the yen pairs are up about 150 pips since Sunday. That's good. So we need to be grateful for that. So thank you, Forex. Mucho gracias. We'll start with commodities today. Why? I don't know why. My oh my WTI holding up on our support, back into the range. Neither bullish nor bearish. Okay, you can see on a small time frame if it rolls over here, that, right? Oh yeah, my drawing tool doesn't work, does it? Let me try one more just out of desperate. I need to reboot this machine. How come I don't do it? Anywho, yeah, I'm not going to have it. Anywho, what you're seeing is this top versus this. If it rolls over here, you'll notice that that's not even a 786, so that's sort of nomad's land, but that is a sell zone for a bear. And so maybe, you know, it threatens this support, but not the lower support. So if anything, we're just sort of, we were way oversold, overbought, oversold, overbought. We're just kind of rolling around sideways. Not much up, not much down. And you'll see a lot of the assets have been like that this week, but you should expect something like that this particular week. Okay? But nonetheless, we do want to see oil prices not falling. Now, today I am going to give you a price forecast for oil over the next year. Maybe you're interested in that. So let me remind everybody that today at 4 p.m. Eastern Time, every single member of FX Bootcamp will have access to my live 2022 outlook and forecast for commodities and currencies. Right? I think it's about 20 slides long, approximately. Maybe 15, I think it's maybe 15 slides long, but I'm pulling in data from, I don't know, the World Bank, the Fed, Goldman Sachs, PIMCO. Oh my God, there's a lot of information, right? So, Master Trader, I will put a link. I'll put an alert. So when you log in, so this is to all members, video only members, swing trading group members, day trading group members. Okay, it's all at fxbootcamp.com. If you're new or not in or haven't renewed right now, in the description below this video right now, the coupon code to save 80% off joining. So let me tell you how much it is if you want to join. $77 for 60 hours worth of videos. Come on, bro. Come on. Kick down, come clean. Don't be a holdout machine. Let's go. Okay? I did that because I want you to be a member of FX Bootcamp. Yeah. Cool. Yeah, so it's just, so I wrote everything out. And, yeah. So anyways, I'll see you tonight. I'll see you this afternoon. Cool. Yeah, maybe. Hey, Lucas, I don't know what more to do. Right? I don't know what more to do. So, yeah, like I said, I'll send out a ridiculous offer, and I think that's a ridiculous offer. Yeah. Right on, Mohan. All right. So, anyways, we're just caught up in here. This is what we did yesterday, and you can see just sort of like what I did is I grabbed this old resistance. Now it's support. And, you know, so far today it hasn't done much. Just, you know, nor do I expect it to do much. So that's interesting. Okay. Bitcoin has stabilized but gone nowhere. Okay. So most of these commodities are somewhat sideways. Taking a look at dollar. And let's see. Okay. Looks like bullish plan A has worked. 132.03 was our line. And we're on our way. The target I lined out on Sunday was 133.05. Not a lot of pips. Okay. Now, look, if you were a bear, you probably tried here and in here, whatever, and it didn't work out and you took a small loss. Yeah, that's how it goes. Small losses, big wins. Okay. So it's a very conservative target here, but I don't expect much breakout. Now, eventually it will break out. Will it break out now? Will it break out in January? Yeah, I don't know. Okay? So it's still a modest move, right? It's a modest move. The question is, and we posed this question last week, is this a higher high for you? Does this make you bullish? Now, I find it very disappointing that we dropped all the way back into the range and now that we're kind of breaking back out again. But at what point do you trade this like it's a higher high, right? For example, do you buy a dip back to, 130, 132.75 or something, 132.80? Are you going to buy a dip and take it up next week kind of thing? Okay, going back to Euro on Sunday, we had this probably moving sideways, not really down, not really up. I mean, up, but only to the top of the range. So sort of, upward mediocrity. Okay. Well, Chand, they're indices. So if you're looking at indices, you're looking at Great British Pound versus everything. So it'll tell you stronger weak. So anyways, going back to this, it was sort of like upward mediocrity. And all we did was get to the middle of the range, and we've done really nothing. Now, bulls bought it at a bullish buying zone. And that makes sense because you can't sell it down there unless you're delusional. Okay? But you can sell it at 113. And the problem is, bulls have done all right, but over the course of 3 days, have only made modest gains. There's no comfort. They're not like, oh my God, this euro dollar trade is crushing it. Like, basically, they're like, what am I up, 50 pips? You're like, that's it? So you don't really know what to do. I mean, I guess you got your stop at break even, but you're not really crushing it either. Meanwhile, bears, they might have sold it late Monday or early Tuesday, and they're just a little bit, right? They're losing, 13 pips right now? And so they don't know. They don't like the slight higher high, but they're not like in panic mode either, right? So they're just like, well, triple top is disappointing for sure. And maybe it's an opportunity to get out while you're still at the middle, because remember, if it doesn't, right, if it's not going to fall there and trend down, well, then you have this risk that it's going to go up to the next level. So you could just take the 5 pip loss or the 10 pip loss, right? Whatever, take your loss. So it's not really much concern for a bear, and it's better for a bull, but nonetheless, upward mediocrity. Okay? So that's all. Aussie, okay? This is going back to this idea of a plausible breakout. Not that it would do it, but it's more of if you believe, right? So in this conversation, since the other ones I made more bullish in the analysis, this one I made more bearish in analysis. And what we had concluded was a bear might sell it here for a target down there, but you got to be careful with those types of trades in a range because you're in the middle, okay? And the middle's not a good place to trade. You either buy low or sell high. You don't want to do much in the middle because that's where pigs get slaughtered, right? So what was sort of more interesting was if you were a bear, again, that's going to come down to your fundamental bias, okay? If you're a bear and you're looking at a chart set up like this where we're on Sunday, we were here at 71 on Sunday. It was more like, well, the way that the chart reads, okay, is it either just head straight down and, right, it trades out of position and you'd hit down here early in the week and counter trend, but more likely is up to the shoulder and then down. Okay, so again, this chart doesn't say it's going to do that, but it was more like if you're a conservative bear trying to trade this, 71.73 literally is what we said back on Sunday, and look where we are, 71.73. 71.73 is a line in the sand for us where you could now, if you are a bear and are looking for that head and shoulders type pattern, now you would zoom in and start analyzing on a smaller time frame. Right? And you'd probably kill the 21.55 200 on this time frame because you're not interested in that data. You were interested in that on the higher time frame, and even on the higher time frame, there was no market or trend. It was basically sideways for a week and a half, right? So now it's more like now you're in an area of opportunity, an AO, okay? And you might sit here and trade the 5A cross down because you got your first sort of check, if you will, 71, 73. If it rotates over, if it rolls over here, take a shot, right? Drop a stop and let it run while you take a walk, okay? That's how you kind of tiptoe into this. So again, I'm not saying this will fall. I'm not saying you should be a bear, but you could be. Now, what's your argument? Well, dollar's been strong for weeks now, about 7 or 8 weeks, which is unseasonally strong. Okay, so there's something going on. Maybe there's Omicron news. Maybe there's some other news, whatever. Meanwhile, okay, Australia is not going to raise interest rates this year. They're not going to raise interest rates next year. They're not going to raise interest rates the year after. Now, the funniest thing is those interest rate hikes were priced into the Aussie. Even if you look at the Aussie bond market, right, analysis of price indicated that the market thought the Reserve Bank of Australia was going to raise interest rates in 2022. Well, I actually listened to Governor Lowe, and he said there's no way in hell they're going to raise interest rates, and he doesn't even understand why they're priced in because they're all wrong. So that's really interesting. So you might say, well, therefore, when you see Aussie dollar appreciating, you're going to take a swing low, right? You're going to trade this down at resistance. And this gray zone is resistance, and this would be how you time your entry on a 15-minute chart or even on a 5er, okay? Depending on how aggressive you are, okay? And that's how you break that down. So it's not like when we look at that now, going back to a 4-hour, it's not like, I predict that this is going to happen. No, it's more like if that's what you believe your strategy should be, in particular this week, this is actually a weekly swing, that's how you break it down into digestible pieces. Okay, you don't sell low, so you didn't have a chance of Sunday or Monday, unless it broke through. That's called an out of position trade, and you'd be riding the 4-hour 21. And that never actually materialized. It just held. Then it went up. So your actual most conservative plan is the best plan, but you're still not short. Yeah. Hey, yeah, Brad, I've been pushing off a conversation with you for a long time, right? So I have a little more time now. And so I'd love to talk more about what you're doing, but I'd love to look at other things like, I know there were some redactions and stuff. I'm interested in, what you're doing with your stops, how big the stops are, what the winners are, the certain calculations, because what you're doing is obviously great. But there's a trap inside of that too, right? So if you want to have a larger conversation, I can try to make time. But congratulations, that's fantastic. Okay, Darko's like, it's on weekly M3. Yeah, well that's what we talked about on Sunday. Like that's how you do it, right? 71, 73 is the number. So now you have to drill down. Okay. Looking at Kiwi, again, not a great pattern here on a 4-hour. It's still technically bearish, but we have somewhat of a high. We have somewhat of a bottom. See the double bottom, see the M2, great. But the problem is that's a bullish setup in a bearish market. Okay? Okay? Elm, yeah. No. Because there, yeah. Well, I guess you look, I'm an analyst. I'd like to analyze the, ratios, for example. Yeah. Yeah, ratios are important. So, because to me, look, if Brad, for example, has, 100 wins in a row and they're all, somewhere between 50 pips and 300 pips, then great. But there are other situations where the 100 wins in a row may not be good. So it's more like, he's trying hard, working hard, getting good results, attracting interest. How can I help? Is more of the attitude. Okay. Okay. All right, cool. So, Aussie, Kiwi, kitty cat. Okay. And yeah, I remember having this conversation, but I don't. Oh yeah, the upside, if this is going to turn bullish, okay. If it's going to turn bullish again, okay, this was the last setup. Maybe there's one sort of in here now. So I guess this is saying watch this 4-hour 21 for additional up. Okay. You see it? Ooh, in love and war, there ain't no rules. So, if we're doing our standard operating procedure, the first op was down here on the pullback, okay, at 27.89, I guess it was. So you're long at 28. We're at 29 now, so you're up 100 pips even with the pullback. And now the next move should be off this roll reversal 4-hour 21 to the ultimate target of 130. So this on Sunday, this was a 200 pip opportunity. Actually, Friday. So this is an interesting opportunity. So once again, we don't know if it's going to go up, but it's an if-then statement. On this 15-minute chart, what would you want to see before you decide to buy it? Okay. Yeah, Darko brings up a good point. Having sort of a multi-strategy ability is important in trading. Okay. It's not every fund would likely to do it because, well, it changes the reasoning of why people would participate, right? But what Darko is saying, though, is like, for example, a macro strategy requires in it a trend. That's what it basically means, right? Global trends, the flow of capital over periods of time for logical reasons. Okay? Simple things like China buying iron ore and coal from Australia because their economy is booming and they need steel. Pretty simple concept. So you'd have to look at China first and say GDP is good now and predicted to be even better in the near future. Therefore, demand for material to power the growth, if you will. If you're going to build machines, if you're going to build ships and airplanes and skyscrapers and, like in that case, capital, if the country needs to invest and create capital in the form of physical capital, right? Right? What do they call it? Plants, PPP? It's in accounting, right? Plants, PPE, isn't it? Plants, something, and equipment, right? Anyway, so if you're building stuff because your economy is growing, well, then there could be a flow of financial capital, aka money, out of China into Australia, and that's what you would trade, right? And so that's a macro trend. This country's doing well. They're going to do more business with this other country. So money will flow one way, stuff will flow the other way. And that would be a macro trend. And you would see that technically in the charts, right? I mean, that would be confirmed by technical analysis. But then we're in sort of this period where October was great. And then things changed in November because of Omicron. And then all of a sudden, the Fed changed the policy, right? They just announced the taper. And then they're like, no, we're going to double the speed. Holy crap, right? So what that did is it kind of kills the long-term macro on the short run. Short run meaning, let's say, a month or two, okay? Six to 8 weeks, for example. I don't think it'll be a forever thing. But what happens though is the fundamentals don't really change. There's this period of have they changed, and it's a question. Okay? So then you lose your macro trade. So now, right, a different type of strategy would outperform in that period of time. So Darko's saying, well, can you switch? And if you've done really well over the last 6 weeks, buying low, selling high, buying low, selling high. That's great, right? Right? Yeah, and I forgot about that, but yeah, so like that would be the right. So this is what Darko's saying, right? That is the better strategy right now, and that's outperforming, which is great. Like, my God, you're clearly good at technical analysis, right? Now, the next thing, though, what Darko's alluding to is if we can get back to macro trend, or when we get back to macro trend is likely to outperform, right? Because you would never want to take a 55 pip profit on something that could move 300 or 500 pips, let's say, right? Right? But you're saying, well, then you'd build it every day, but then you can't build on top of the previous capital, right? So it's harder to, right? It's let's say you're making, I don't know, and I'm not just speaking to you, Brad, I'm talking to everybody. This concept of once you get the trend going, what you don't want to do is like make 55 pips a day and then you're done and you clean out your account and you have no more trades open. Then you go to bed and you wake up in the morning and you got to go to work and you got to find your 3 trades, and that takes effort and time. And then you pull the trigger and you try to get 55 pips. And then once again, you're done and you clean out your drawers and go back home, right? As compared to someone that maybe does the same amount of work, they wake up in the morning, they open up their charts, they look for their trades, they set them all up, they take the time, they place the trades, drop the stops, walk away, and then they come back the next day just like you would, find their 3 trades of the day, place those 3 trades. But after 3 days, they might have 10 trades still open. And they're still making, let's say, 55 pips a day, but it's on per day now. So like the first 3 trades, let's say, make 55 pips, right? The second make 55 pips, but it's each day. And the third day, 55 pips. So on the trades you made on Monday are now up 150 pips, let's say. On Tuesday, those trades are up 100 pips. And on Wednesday, you got your 50 pips, right? And so now you're up hundreds and hundreds and hundreds of pips versus 150, right? And so that's the beauty of compounding, right? And when you're in a trend, right? Yeah, no. And that's what I'm saying. That's why multi-strategy, right? Right? So that, I think that's what Darko's hoping for, right? I don't think he's negatively critiquing. It's more like, dude, that's awesome, right? We all hope that when or, if, of course, when we resume a more fundamental trend, right? That you open up the sails and you let the wind do the work. A question here is, asking my opinion, is 55 pips spread a large win or not? Yeah, well, let's ask that. How much is the 55 pips worth? Okay, so like a euro dollar, mini lot, that would be $55 spread. That'd be ridiculous. 55 pips would be ridiculous. Even 5 pips is inconceivable. But 55, that's ridiculous. Now, on like a USD Mexican peso, or you're right, that might be a 55 pip spread, might be $5. And now you're like, oh, well, that's totally reasonable on an exotic pair. You're like, that's higher than euro dollar, but not by much. Plus, you get the benefit of receiving the high interest payment every day, which would offset that extra cost. So in that case, 55 pips would not be. So don't think of it, don't say 1 pip and 1 pip are equal to 1 pip. Okay? Brinsley says, what if you take 3 trades, take profit on 1 and leave the other 2 the same day? Well, here's the thing, Brinsley, right? Like, I can't poo-poo on that strategy. That's fine. But the thing is, when people say that, what they're admitting is they don't know when to take profit. So they're like, well, I don't really know where this is going, so maybe a good way to handle it is just get out with something and then hope the other ones do more. But I just don't even like the attitude. Like, you should get in when you're supposed to get in. You should get out when you're supposed to get out. You know? So like this idea of take half your profits and let it run. Why? If your trade plan was this trade was worth, let's say, 200 pips, why would you take half of it off the table because you have a 50 pip profit? Like, to me, I don't get it. Well, but what if it, but... Okay, there is no but what if, okay? Okay, there is no but what if. Now, some people over the last 7 weeks have been really, kicked in the shins by volatility. And I'm one of them because, again, I'm a macro trader. I'm not going to perform well with high volatility. It's just not a macro trend for the stock market to fall 4% in one day. Okay? Like, that's not a macro trend condition. So my performance, if I'm a pure macro trend trader, is going to be underperforming in a period like this. And like someone taking day trades, actually I found swing trading to be the best recently. So even day trades are hard because you'll get like a giant red candle one day and then boom, a full green candle the next day, right? Like up 100 pips, down 100 pips. You're like, what the hell? So even day trading can be a bit difficult. So it's sort of more of a swing trade kind of scenario, right? But unless you're really good, just buy at the top, sell at the bottom, and be done with it, okay? So you can see that different strategies are appropriate for different reasons. Now, being kicked in the shins by volatility, what it shouldn't do is say, oh, I'm not performing well here, so I should change what I do with this strategy. No, you should have a different strategy. Okay, so I don't want you to get like you're a trend trader, but you're going to take off half your profits because you're up 50 pips. Dude, well then you don't believe in the trend. I'd rather you have, and I've recommended this in many cases where you actually have 2 accounts. One is like for swing and position trading and one for day trading and scalping. So I'd rather you say, okay, I'm long-term long, but this is a bearish market. So I'm going to not swing trade or position trade. I'm not going to trend trade. In this case, I'm going to kind of counter trend, if you will, and say, I'm going to go with the dollar strength, even though that's very unusual this time of year. I'm going to go with it because that's what it is. It just is. Okay? So you're changing the strategy and say, okay, in this case, I'm going to deploy, an intraday strategy. Right? It's like you're using a different algo, if you will. Your algos might analyze the market and say, stop swing trading, start scalping. But I wouldn't want you to combine and say, I want you to enter like you're a swing trader, but then do risk management like you're a day trader. And like, no, dude, no. Okay, so I'd rather, again, going back to this Brinsley's question, it's more like this. I want you to focus on what the trade plan was. And a lot of people just start trading and they forget these rules of engagement. If you bought it on a weekly M2, your goal, your target is weekly M4. Not halfway there, take half your money off and then start praying to every god you can find. Please make it go higher. Like, I'm exaggerating for effect, so I know you're not doing that, Brinsley. But the idea here is move your stop to break even and let it run. Okay? If it doesn't hit M4, you should record that on your trade journal as a -3 pips. Oh, but I could have had, but dude, you're going to kill your Sharpe ratio, right, Brinsley? So at some point, what it'll look like is when things are bad, you lose money. But when things are good, you get out early. Like that, you don't want that either, right? You don't want to lose a lot of money when times are bad, but you do want to make a lot of money when times are good. So I would rather your trade history show in times when you're underperforming, your risk management protects capital. The second thing is when things are trending well or market conditions are favorable to your strategy, that you outperform, not underperform. You don't want to underperform because you took half your trades off because you wanted to book a profit. No, I don't want that, right? And that's why I'm like, and that's why the concern where like we want Brad to also be a trend trader on top of that, right? So it's like when the conditions are favorable, you must outperform. And then over a long period of time, they average. But they average in such a way where when market conditions are not favorable, you lose small amounts of capital. But when conditions are quite favorable, you grow that capital significantly more. And then in the middle, there's always just mediocrity, right? But when you look at sort of the returns, what you want to see is small losses and big gains. Okay? Okay? Cool. Okay? Right? So, boy. Okay? Boy, oh boy, oh boy, oh boy. Interesting stuff. This is a really interesting year, to say the least. Remember, we have two crazy things going on. One is Omicron, and COVID is back. And yeah, we're not going to shut things down, but people are getting sick and all this stuff. And like, what? We thought we were through this. And you have to remember, in the fourth quarter, a lot of people's models for 2022 was everything is going to be great. And then all of a sudden, like, what? Is that in jeopardy? Do we have to reduce growth outlook and all that kind of stuff? Okay, so we have to look at that. But then we also had this, change at the Fed. Okay, so the taper brings some dollar strength because of what I call rotation. Okay, it forces investors to change the type of investments they make. But then the Fed, the very next, even half of a meeting later, because it had to do with congressional testimony, he's like, yeah, we'll probably have to speed up the taper. Whoa, what? You just announced it. Like, you could have tapered 6 months ago, but you didn't. And now you just finally announced it, so everybody changed their investment strategy based on this new Fed policy. And then like 2 weeks later, you're changing it again? No, it's not a 6-month taper, it's a 3-month taper. Like, dude, what the freak? And so if you're like, where's all this volatility coming from? It's stuff like that, man. Right? You're like, oh my God, dude, you went from we're never going to taper, 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 never. And all of a sudden, now we're tapering. Oh, now we're doubling the taper, right? You're like, wow. So we got interesting. Do you remember like 6 weeks ago, I said, hey, we're in cross currents. And then Omicron hit us. Oh my gosh. And then the double of the taper. Oh my gosh. So these are strange times, right? So like, let's look at yens now because they are performing quite well for today. But like, I was looking at one of these just sort of recently. I forget which one it was. But like, look at this. From Wednesday to Wednesday, price didn't change. Well, let's say Tuesday. Tuesday to Tuesday, price didn't change. To Tuesday, price didn't change. 80.70, 80.66, 80.74. I'm not just looking at the pivots. I'm actually looking at the price. Okay? You're like, what? December 7th, 80.70. December 14th, 80.70. December 20th, 80.70. Yeah, and with some ups and downs. What did the higher create? A lower frickin' low. All right? A higher high created a lower low. You know what? I forgot to put that pattern in my book. Okay? Okay? Yeah, no, I know why you're doing it, Brinsley, but it's the if in your sentence that bothers me. It's more like I'd rather you have more, or I don't know. I made my point, right? So I'm not poo-pooing on your decision. I'm giving you my thought process on that, right? So anyways, so we're back up on the monthly, and of course that projects us all the way up to 84.5, but we got a lot of work to do yet, right? So, but this idea of all the way up, all the way down, is just unusual amounts of volatility, right? If you look at Kiwi now, check this out. November 26th, 77. Okay? December 8th, 77. Right? December 13th, 77. December 15th, 77. You get this? Right? December 17th, again, like the next day, we went up 100 pips all the way back down to 77. And then here, December 20th, we were at 77. Holy frick-a-zee, eh? Okay, interesting, right? So if you're like, man, I'm not getting the results I expected for my trend trading. Well, yeah, that might be why there hasn't been a trend since the third week of November. Now we're in the third week of December. So this in here is, this is good, this is bad, this is really good, this is really bad, this is good, and this, whoa. But okay, one of the things that we might be grateful for is this is likely the bottom. Okay? Omicron, not the ongoing misinformation. Yeah, well, so I'm going to address that generally in today's outlook. And the interesting thing, though, is like the U.S. is about to announce that they have COVID pills from two different, I think Pfizer and Moderna both have COVID pills now. Okay. So if everybody gets, by the way, just out of my own life experience, I know lots of people recently that got COVID. Okay. Last year, I only heard about people getting COVID. Now, lots of people in my circle, my community, have gotten COVID. Men, women, okay, young, old, doesn't matter, okay? Now, the second part of that is all the people I know that are anti-vaxxers, like, they're not going to get the vaccine. They all have it, every single one of them now. Probably 5 people that I know that are anti-vaxxers, they went through the first 18 months, not a problem. Omicron shows up, they all have them. Everybody. They got them. Every non-vaxxer I know has been hit by COVID. Okay? And then a few others I know have gotten COVID, but now it's like in my circle of friends. Okay? Okay? Now, Elm says, that's why I don't swing trade. Okay, whatever your conclusion, whatever got to that point, I would try, okay, Elm, I would try to have you, I would try to convince you over, not through argument, but just through education and examples or whatever, to learn swing trading, because I believe it performs the best. And there have been fine examples of swing trading even recently. What's different this time around is the volatility. So typically when you swing trade and you're up 150 pips, the next week you're going to add more to that and get that up to 500 pips. But what's happened is your swing trade long, bullish swing trade slams into a bearish swing trade and it gets taken down from the bears. And that's unusual, but I'm telling you, there's a lot of value in swing trading. There's a lot. And if you're good at day trading, like you're indicating you are, you're going to love swing trading. But what I don't want you to do, Elm, is say, I don't like that, and I'm not going to look at that because of whatever experience you've had. I'd rather you say, I'm open-minded. I love day trading, but I'm open-minded to learn and see how I can learn to let the winners run more. Because, Elm, I believe it's a universal truth, okay, that the secret to long-term success is your ability to let your winners run. Okay? So if you only, this is the multi-strategy idea, if you only day trade, then by definition you never let your winners run. So I would congratulate you for your confidence and your success as a day trader. And this goes even back to Brad, right? 100 trades in a row without a loss. Yeah, that's great. Awesome. But, okay. Now you're saying it's an up and down. No, it's not. So just, okay. Yeah, okay, so Elm, we can fix that. So consider it like stay open-minded. So like if you can't do it, doesn't mean it doesn't work. It just means you can't do it. So you're probably just missing a few things, a couple of tweaks here and there, and you got it, right? So again, don't shut yourself down from what is known as a universal truth necessary to succeed in all forms of trading. Okay? Okay? Because you can't compound. Your cost of trading is significantly higher. And even in the United States, if you're here, you won't get trader tax status and stuff, right? So you got to have a little more on that. So just all I'm asking you is stay open-minded. Don't say things like, it's all up and down all the time and all my trades get knocked out 95% of the time in the free. Whoa. Just stop. Clear that out, okay? And say, I'm interested in learning more. How? Because if you're great day trading, I'm telling you, you're going to love swing trading, okay? You just don't know how to do it right now, and that's fine. That's what you've confirmed. You don't know how to do it. I think you're going to love it. And it doesn't change anything on your day trading. Your day trading is still going to work. Now, once you learn swing trading, you're going to have at least 2 things that work well for you. And I think that's incredibly valuable, especially in times when there's no trend. Your day trading is going to lead. But when there's when trends are present, your swing trades are going to work, but you're going to be able to compound so great because you're so good at day trading. Like I'm telling you, if you learn just this one other thing, I would not be shocked if you tripled or quadrupled your returns at the end of the year. Because you need to know how to trade, and obviously you know how to trade on the short run, so you're great at entries. That's what you've defined. Elm, you're great at entries. And like what we've been talking about with everyone, with Brad and Brinsley and a few others, there's the next step is, once you're really good at entries, part of your analysis is knowing when to exit. Okay? Okay? But I'll admit, I've had some really good trades this month that went kaput. Okay? But to change the strategy to fit market conditions is weird. It's going to lead to long-term inconsistency. So instead of tweaking the strategy to fit basically your backfitting, I'll take half my profits now. Instead of doing that, rely more on the day trades and like basically change the strategy. It's like in economics, is it a shift along the curve or a shift of the curve? Well, I wouldn't want you to shift the strategy. I'd rather you change strategy. Okay? Okay? Yeah, that's a funny quote. Yeah. Okay? Cool. All right. So actually, a lot of this trade here that worked overnight, it's actually a bit of a I would say a challenging trend, a challenging trade. And if you took it, it may not have even been a good trade, even though this is classic, right? This is a classic day trade, kicking off the 21, kicking off the daily central, all of that. But the thing is, in that moment, we were not really trending. In fact, we went from the bottom of a range to a top of the range. And so to ignore that would be like you're so confident this is going up that you're going to ignore the obvious. And I'm not really sure where you got that level of aggression. Now, maybe you bought down here and you're feeling really good because it's working out. But nonetheless, to get to where we are now, okay, let's kind of move it this way. Oops. To get where we are now, sure, it's not even going to drop. Okay, let me do it this way. Okay, to get where we are now, you had to ignore an obvious risk. So even if you're on this trade last night, I almost, like it's weird, right? Because like I am bullish on this pair, but like, dude, you ignored a lot to make these pips. So it was risky, man. But maybe, I mean, again, I was going to say, well, maybe you could, no, that was a risky, almost foolish trade, but nonetheless, it was a good setup in a bad market condition. Okay. So anyways, so like that would be an example of something that worked classically if you're only going to look at this time frame. That's a simple day trade. 128.50, for example, and it dropped down to 55 off the 21. I mean, dude, it's a classic setup here. London took you north. But in the moment you probably traded it, it was probably very inconclusive and even more likely to fall to rise. and yet you took it and made money. So I'd be careful. Now, we're at 129.20, and that is actually the target for that trade. Okay, so what technical analysis is saying is bulls should take profit here and buy back on a retest of 129. Okay, the danger now with all this vol is that creates a top that we're actually here now. Okay, you see? I don't know if we're going to have the continued vol or if this is going to run for the rest of the year. I don't know. Technical analysis won't teach me that. But like the decision for tomorrow now, I'm already on tomorrow, by the way, to Abdul. Okay. Here's the concern, Abdul. I look at this and I don't see the trend. I see the range. Now you might say this broken out, but I've been here before. I've been at this price before and it did not break out. In fact, I was 70 pips higher than this and it didn't break out. So what a normal trend would work this way. Okay, Abdul? You'd buy tomorrow at 129. Your stop would be down here, 128.75 or something. And your target here would be 129.61 to 63. Okay? That's an M2, M4 swing. Okay? Central pivot to R2 day trade. So we have a confluence. This is the peak for the week. Literally, the day rally is the peak for the week. And in which you should, if you actually get up there, be quite concerned about now this top. Like that is hardcore. But going back to tomorrow, it's likely to go through this again still. This may not have broken the range. It's almost as likely to head all the way back down based on what happened last week and basically what happened the week before. We've had some big pullbacks. And nothing really technically says, hey man, this time it's different. Well, whenever you hear that, it's almost never. Okay? Okay? When you hear, oh, this time it's different, it's almost never different. In fact, it's never different. So like, statistically speaking, you might be thinking, okay, I'm just going to buy a dip and rally it up, and that might actually work. But even then, this still says statistically there could be a bigger pullback. So it's harder. Like trading here as a bull has got a lot of danger on it. And bears, I know, must be thinking about taking this back around. But fundamentally, I believe this will go up. Okay? And you're like, well, that's really convoluted. It is convoluted. Look at what has happened since the middle of November. We've been to this price before, here, 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 and here, and it's always fallen over the course of 1, 2, 3, 4, 5, 6 weeks. Every time we hit this price over the last 6 weeks, it's come down at this price, at this top. So if tomorrow is a buy and rally, well, we got all these times where it's come back down. But look at this other, role reversal. You can see was support, was resistance, was support, was support, was resistance, was resistance, was resistance, okay? Was resistance here, was resistance there. There's a pretty reasonable chance that this can come down. So I want you, instead of really, because like whoever traded this last night made money, it's a day trade inside of a swing trade, but the swing trade didn't exist. There's no trend here. Okay? So like, let me get rid of fair market value. Okay? Well, first of all, look at fair market value. This currency pair is not overbought. It's not oversold. We don't know who wants to do what with it because everybody agrees. It's not really bullish. It's not really bearish. And then if you look at the definition of market, it was bearish here, and then it's been sideways ever since. In my book, I call that braiding. And braiding is a danger zone, but it does tell you to stop trading trend and start trading price. It's very specific in the market, right? In the book. I think the language is stop trading the market, start trading price. And that's where, like, for example, Brad is just crushing it, right? Because you're like, buy low, sell high, buy low, sell high, buy low, sell high, buy low, sell high, buy low. Okay? Okay? Yeah. But the evidence is that's likely to outperform, but we should also indicate that it's not easy. Look at some of these trades, guys. You bought it here, and literally 4 hours later, the whole thing collapsed. The next day it collapsed. Then you bought it here, and the next day 100% collapsed. And the next day you bought it, and then 100% collapse. And then the next day you bought it, it went up for 2 days, and then 100% collapse. Then you bought it the next day. Remember, every time it collapsed, you bought it back? Really? Wow. Then we had this dramatic day followed by a total 100% collapse. And then nothing, and then nothing, and then nothing. And then it broke out, and then it pulled back. And then it broke out, went way, 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 way up, followed by way, 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 way down. So you bought it? Way, way, way. Dude, it just fell for a day and a half, and then you bought it. Well, it was at support. Okay, that's a whole different game. Okay, that's a whole different game. That's a whole different skill and, strategy, I should say. And I'm telling you, even if you're backward looking, to actually do it is difficult. And that's why, like, Brad should be congratulated. That's a tough gig, man. I think even psychologically, I hate buying things where you have a big, beautiful, bullish day, followed by the next freaking day, it's big, bearish again. And then you do it again, and you do it again. And there have been times like you could have been on all of these trades and broken even on every one, but you just don't have the heart to buy it for the fifth time. You know, like, right? Right? And then, of course, the time you take 50 pips on it, it goes up 100. Okay, so I look at this, and most people lose a lot of money here, but what I prepared people for many, many months before we even ran into this, I prepared people for the greatest risk, and that's where they lose confidence. Okay. Abdul says that's why having a big stop is needed. No, that's ridiculous. Okay, again, Abdul, and to everybody, if you have to write this down, great. And if this pisses you off and you hate my guts, it doesn't matter. I don't know you anyways. So maybe you could just listen for a second. Okay? Don't get mad. I'm going to say something. And you're probably going to disagree with it. It's okay. Just relax the mind here for a second. Okay? There's two things that I believe are necessary for trading successfully over long periods of time. Okay? Your winners must be big, and your losers must be small. Okay? So that's where I'm going to start from. Like, I believe that's my core. That's my core. I don't care what strategy you use, what kind of technical analysis you use. You're like, you don't like MACD, but you love the RSI, or you love CCI, or you use DeMark strategies. You use Elliott Wave. You use, whatever, man. I got nothing but love for you. I might not do it the same way as you, but I might understand how you're doing it. I could probably look at how you're trading and understand. I'm not too dumb. But I do have a base level understanding where everything builds from this concept. Okay? Small losses and bigger winners. And I can tell you, having been a professional investor as well as being a professional trader, things like Sharpe ratios are important. It's what an investor looks for. It's one of the first go-to, if not the first go-to. Okay? In my class at Oxford, doing algorithmic doing the algorithmic trading program, the first day of the first class, we discussed Sharpe ratios. Okay? You understand, like, day one of how to analyze a strategy. That's what all algorithmic trading, all it is, basically you program a robot, if you want to call that, an EA, whatever you want to use, your strategy, whatever it is. Okay? And then you analyze whether it's good or bad. Is it performing and is it compensating for risk? Okay? So imagine that. The whole class is analyzing performance, in particular risk-adjusted performance. So I can analyze any trader, any algo, and I can do it quickly, right? And day one, it's Sharpe ratios. Well, what is a Sharpe ratio? It tells you risk-adjusted performance. Are you being compensated for the risk you are taking? So how do you break that down in digestible pieces, right? Going back to Abdul, your winners must be bigger than your losers. Okay? For example, if you have 50 pip stops on average and 50 pip winners on average, you're fairly compensated for the risk, but you're not outperforming the risk you're taking. You're actually neutral. Okay? And so people look at it like, okay, I can invest with you. You are making money, but you're not really, but there's no reason. You're so neutral that I could probably take almost any other kind of investment opportunity and outperform that. I might as well just buy some real estate because there'll be a lot, right? It's illiquid, but whatever, right? So to make that work, okay, unless the algorithmic trading program at Oxford is stupid. Now, you might think that, but I'm telling you, these mathematicians that I learned from and the professionals they brought in, these guys were really, really smart, really talented. Not just traders, but we had like the global risk manager for Morgan Stanley, stuff like that. I mean, huge people, right? And they're all talking about risk management, right? And compensation and all that, right? So going back to all of this, okay, this is part of why it's my universal truth. Now, it's always been my universal truth, but when you're looking at analyzing risk inside of performance of traders using mathematics, okay, it's required that your losses are small, which is your risk. Your worst case scenario is your loss, and that you're taking that risk because the opportunity is worth more than the risk. So if you have a 50 pip stop, you should have, let's say, at least a 100 pip target. If you're taking a 100 pip stop, because I don't know what big stop loss means for you, but if it's 100 pips, you should be going for like 2, maybe 300 pip trades. Okay? Okay? So there you go. Okay? It's a universal truth, in my opinion, having listened to many professional traders over decades. That is a common theme. If it's not working, cut it quickly. If it's working, let it run and add to it, baby. Get big fast. Scale. If it's working, scale. And that's what I want for Brad. Right now, what's working is not scale. But at some point, you want to scale. You want to get big. You want to build on a trend and ride the heck out of it. Not just watch it sail into the sunset, but add to it, add to it, add to it, add to it, add to it. Get big, scale up. Get big, okay? And that's ultimately the secret sauce. But you can never get away from, when you're wrong, be a little bit wrong. And it's okay to be wrong. In fact, it's totally okay to be wrong. But when you're right, be very, very, very right. But that to know the difference between an okay trade, a mediocre trade, a good trade, and a great trade, to understand that, you will need to know things like fundamentals, seasonality, global money flow, all these different things that go into that, monetary policy changes at central banks and the divergence between them, and even the difference between a major currency and a reserve currency, and all these different things are all built into this. So yes, start at being a good day trader, start at being a good scalper, get really good at price action, timing of trades, right? Using, the tools that you have in front of you, get really, really, really good on that. I agree. That's a great place to start. Now, the next thing is learn how to scale, learn how to get big, learn to basically institutionalize. Right? You need to have an institutional quality track record. Okay? Cool. If you trade stop is 30 for 60 pips, that's fine. Okay. Okay. So here's an interesting conversation, right? Well, Master Trader, I'm worried about copper, not in regards to demand, but against supply. So we have a new government in Chile. Chile is the largest, or at least significant, supplier of copper globally. And they put in a populist government, and they're jacking up taxes. And I don't know if that's going to negatively affect the copper mining industry. So I think there's a little extra risk on that. Yeah, thank you, Johnny. I'll see you later, 4 p.m. So again, today at 4 p.m., I'm giving my 2022 outlook using data from, OPEC, the World Bank, Goldman Sachs, CME Futures, PIMCO, St. Louis Fed. I'm just going from memory. A whole bunch of really good resources and research went into this. The National Association of Realtors. So I'm even giving sort of an outlook on housing prices, commodity prices, currencies. But more importantly, I'm kind of threading the needle of why I got to that conclusion, but also who else thinks in similar ways. You've been living underground, eating from a can. You've been running away because you don't understand fundamentals. Yeah. Okay. But look at this pair here, pound yen, the beast. And we've moved from basically the monthly M2 to the central pivot point. That is a crazy tight month. Well, to me, the slow part, I'm okay with. But, like, for example, this pound yen, okay, going all the way up, to me was quite predictable. And then for others, it's predictable to come down. But one of the catalysts of this move was the change in policy of the Fed. So you're like, oh, there's a new fundamental reason. But then, whoop. And now we're back up here again. You're like, gee whiz, golly gee whiz, Batman. Okay? And so it's the volatility that hurts more than anything else. Yeah, so that's the thing, Abdul. This idea, by the way, I didn't say gold would go up. But nonetheless, yeah, the misconception of people preaching old news, if you will. That's what gold has done this year. We started, right, in January, we were at 1805. So let's just say 1800, okay? If you go back to October 2020, we're at 1800, okay? So October, 1800. January, 1800, okay? April, 1800, okay? June, 1800. July, 1800. August, 1800. October, 1800. Okay, December, 1800. Now there's some little lows and little highs, and that's what we call standard deviation. Okay, and like statistically, not a lot has happened. Okay, and you can see now if we move it closer, the standard deviation is narrowing quite significantly, right? Okay, we went from there, an $80 standard deviation from $100. Okay. I'll record it, but I'm not going to leave it there long. Because it's more like I actually don't know the future, but I want to give you an example of my thought process of synthesizing different fundamental resources of information. Okay. So anyways, gold right now has a much smaller standard deviation. Sorry, I said 80, but it's actually closer to 60. Excuse me. Oh. 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 Excuse me. What free source do you recommend for fundamentals? No, you're looking at news. News is not fundamentals. Okay? Trading the news is not fundamental. That's high volatility or volatility strategy, or it's actually called an event strategy. So like there's two types of, well, there's probably three types, if not more. Okay, there's multiple types of event strategies. One would be like merger arbitrage. Okay, where companies have announced or just announced a merger, and it may happen or it may not happen. That's the event. Many times the companies don't merge. For example, the government doesn't allow it to happen. So the stock prices will adjust, and you could make trades on that. But the idea is an event. The event is based on a calendar. You know when something's going to happen. So, for example, GDP, US GDP is an event. It's an announcement. It's a release. Okay? So news is an event, but it's not fundamental. It's just an event. Now, analyzing over periods of time. Okay, so like an event is like accounting. It creates a balance sheet. On this day, here's the assets, here's the liabilities. Okay? But fundamental is more a flow, like a cash flow statement, not a balance sheet. Okay? It's a flow of data over periods of time that create trends. And then being able to compare this trend versus that trend, this economy versus that economy. What do the economies do? What are their relationships? What are the strengths and weaknesses? And more importantly for us, what is the flow of capital? What is the exchange of goods and services and capital between these two? And based on the analysis of economic data over time, how can we project that out to the near future? Because what we do is actually projecting 3, 6, and 9 months out into the future. So when a news event comes out, we're not trading that news event. We're trading, does that news event change our 3, 6, and 9 month outlook of our fundamental data? And so if there was a negative shift in productivity of an economy and you thought this economy was going to grow 6 months from now, but instead it's not going to grow, you might have to adjust. You might have overvalued that currency and the currency comes down. But an event trader might say, oh, that was bad, therefore it fell. Well, what you end up looking at is there's more than good and bad. Okay, there's more than good and bad in our analysis. So, for example, bad data might lead the central bank to support the economy, like what's happening in China right now. China sees a slowdown. They have risk in their commercial real estate market. Okay, so that could lead or has led the central bank to lower interest rates and cut the reserve requirement ratio, which is stimulative, which could actually be good news. Why is it good news? Because we know the bad news is now. We already know it's bad now. But fundamental analysis could say that change in philosophy, or in particular policy of the central bank, will create a better future. So the negative news, in particular leading the central bank to change policy, creates a better future, which could mean it's good news. The bad news could be good news. But again, if you're just an event trader, you don't really understand that. It just looks good. And you're like, good, this means good and that means bad. But under the same circumstance, 6 months later, you can get the same event, right? The same number is released, whatever it is, 2.3, right? Well, this time the opposite could happen. There's no need now for the stimulus, so the central bank could remove the stimulus. And what do you get? You get the opposite for the same data. And again, in the short run, you might say, oh, well, that 2.3 was bad. Well, it was neither good or bad, but there was changes in the policy of how the government was running their economy, in particular the central bank and monetary policy. And that's what we do, my friend. And fundamentals are so much more of GDP came out 6.8. Well, so what? In context of what? Okay? In context of this year's productivity on top of last year's productivity, but last year's productivity was the lowest in 1,000 years. So any reasonable productivity this year is going to look fantastic. But then next year, it's going to come out, let's say 3.8, and they'll compare it to this year's GDP, and then it won't be good anymore. and they're, right? So yeah, you got to take it another level than, you know, a number is released. News is just an event. Okay, it's a data point in your data set. Okay, so anyways, cool. All right, I think that's it for today. I think we're done, right? We did all right today, right? So again, the link is in the description below. The coupon code to save 80% is in the description below. Today at 4 p.m. inside of FX Bootcamp, I'll put a special link. I'll do an alert. There'll be a link to a Zoom room. And all members, video-only members, swing trading members, day trading members, everybody's welcome. And I'll give you an outlook. I don't know how long it'll take, though. An hour, hour and a half, 20 minutes, more than 20 minutes. Okay? Look for you'll notice. It won't be those rooms. It'll be I'll create something special. I think it'll be obvious. Okay? Cool. And consider it, you know, it should just be fun, you know, currency trader to currency trader. Okay? You and I hanging in a bar talking about what's going to happen next year and why. But it'll also have a kick-ass bibliography at the end because I actually am citing really good sources. Okay? So, yeah. That'd be great. So anyways, yeah, I can't do 20 minutes. Yeah, that's true. Okay? What time? 4 p.m. Eastern Time. Not a cigar this time. No. Cool. All right. Peace on earth. May the pips be with you. May your profits be above average. There's lots to be thankful for. It looks like maybe once again we're breaking out of ranges and waking up and all that kind of stuff. There's still good trading to be done between now and the end of the year. Okay. Where do you get those sources? Well, I'll cite the sources on every slide. So I got to go work on my slides so I can impress you. Okay? I mean, dude, it's a lot of work. I'm a busy guy. You have to remember I'm the vice president of the International Association. The vice president of the International Association of Retired Supermodels. So I got some work to do there, but I'm going to focus primarily today on getting our presentation done on predicting the future in Forex. So I'll see you later. Peace on earth. May the pips be with you. May your profits be above average. Now I got to look for the little thing to end the stream. Is it this button? I don't know. 3, 2, 1.